On Friday, January 30th, 2026, the precious metals market just completely went into free fall. We're talking about a historic, brutal, and totally unexpected crash that left traders absolutely stunned. So in this explainer, we're going to break down exactly what happened and, more importantly, why.
This number, wow, this one number really says it all. In a single trading session, silver futures had their worst day since 1980, plummeting an astonishing 31.4%. And gold, it wasn't spared either, suffering its own massive double-digit collapse. This wasn't just a bad day, it was a total bloodbath.
So, the big question is, what on earth could trigger such a violent, sudden reversal, especially after a record-breaking rally? I mean, was it a technical glitch, a major bank collapsing? The answer is actually simpler and way more political than you might think.
Okay, first, let's just take a moment to really appreciate the sheer scale of this event. This was a market shock that people are going to be analyzing for years to come.
You know, the speed of the crash was just stunning.
After months and months of climbing to all-time highs, the floor just completely fell out from under the market. Billions of dollars in value just evaporated in a few hours. It was the most dramatic end to a euphoric rally you could possibly imagine.
So who or what was the culprit here? Well, believe it or not, the entire sell-off can be traced back to a single announcement, and specifically to this man.
That's right. The key trigger, the spark that lit the whole fuse, was a political appointment. The very moment President Trump announced his pick to lead the world's most powerful central bank, the markets reacted instantly and violently. But why? Why did this one name cause so much chaos?
Well, it all comes down to this one word, hawkish. Kevin Warsh is known as a policy hawk. What that means is he's seen as someone who will always prioritize fighting inflation by keeping interest rates higher. Now, this is the exact opposite of a dovish policy, which would favor lower rates to help the economy grow. The market had been betting on a more dovish Fed, so this nomination just completely flipped the script on everyone's expectations.
But here's the thing, this nomination didn't hit gold and silver directly. Instead, it set off this powerful chain reaction, and it all started with the US dollar.
And this shows you that domino effect perfectly. The market sees a hawkish nominee, and boom, it immediately starts pricing in higher interest rates for the future. Higher rates make holding US dollars way more attractive to investors, so the dollar surged in value. And as we're about to see, a strong dollar is basically kryptonite for precious metals.
Here's the core relationship, and it's pretty straightforward. Gold and silver are priced in US dollars all around the world. So, when the dollar gets stronger, it makes those metals more expensive for anyone holding other currencies. And what happens when something gets more expensive? Demand cools off, which puts a ton of downward pressure on the price.
But the Warsh nomination was really just the spark. The reason this fire grew into a historic inferno was because the market was already soaked in gasoline, just waiting for a match. There were three other big factors at play. First, the market was seriously overbought. Prices had just gone up so far, so fast, that a lot of people felt a pullback was coming. They were just waiting for any excuse to sell and lock in those profits. Second, tons of traders were using leverage or borrowed money. When prices started to fall, it triggered margin calls, which forced them to sell no matter what, pushing prices down even faster. And third, to top it all off, the Chicago Mercantile Exchange, the CME, actually hiked its margin requirements, which basically made it more expensive to trade and squeezed a lot of the smaller players right out of the market.
So you see how this created this vicious cycle, right? Profit-taking pushed prices down, that triggered forced selling from all that leverage, which created even more panic. Traders called it a liquidity wipeout, which is basically a moment where all the buyers just disappear, and there's absolutely nothing there to stop the fall.
So after a historic crash like that, the big question on everyone's mind is the party over for gold and silver? Was this the beginning of a new bear market, or was it something else entirely?
This quote from Moody R really captures what a lot of analysts are thinking. They don't see this as some fundamental change in direction for the market. Instead, they see it as a violent but maybe necessary purge of all the excess speculation and leverage. It's like the market went from pure euphoria to total exhaustion. A painful reset, but maybe a healthy one. And the reason for all that optimism is that the long-term fundamentals, they haven't changed one bit. Central banks are still buying gold like crazy. Silver has a major supply deficit. Industrial demand from huge sectors like green energy, electric vehicles, and AI is absolutely surging. And you can't forget about all the ongoing global uncertainty. The core reasons for owning precious metals are still very much in play.
Which leaves us with the final, crucial question. Do you look at a crash like this and see it as a terrifying warning sign that the bull market is dead and done? Or do you see it as a healthy correction that washed out all the speculators, creating a rare buying opportunity for the long term? That, right there, is the billion-dollar question that every single investor is asking right now.